Greetings,
Hey, everybody.
everyone.
Happy Tuesday to you all. Thank you so much for being here. Brian, I see people from all around the world as usual, which is amazing.
We got Canada, we've got Kuwait, we've got people here from all over Dallas, Texas. I hear they've got a bit of snow on the ground there. Seattle, they probably
Join
do
the
too,
club.
They're used to it. Hey, I feel it because as you notice, Brian, I'm not in a cabin on a coffee farm in Costa Rica anymore. I am back in the frozen tundra of Wisconsin. So
Yes, you are.
It's
You're back
cold
with the
here.
rest of us suckers.
Yep, that's right. I hope the weather's better in Turkey and Germany, where a bunch of our folks are coming in from.
Eagle-Eye Klaus is here. That makes me nervous because whatever we do is going to be scrutinized very, very deeply. Hey, Klaus, thank you for being here. Thank you guys so much for joining us today. And let's get right into it, shall we? We are here to research a stock from scratch, and that stock is ServiceNow. Why ServiceNow? Well, we ran a poll in our newsletter on Wednesday, and it just barely edged out Constellation Software.
Close one.
I was personally rooting for Constellation Software, but software stocks have just been hammered over the last couple of months over fears of Claude and how these companies are just going to be steamrolled by people developing their own apps. So ServiceNow is in a pretty serious drawdown as of the time of recording. So you guys chose it, and we're going to research it live. Now, where does this company fall on the easy business to hard business scale?
I feel like a big part of this depends on if you use this for your job, it would probably be pretty easy, but this is not something that like everyone knows about.
No. And I know this is a great company. I know it's growing like crazy. I know it's been a great investment. It's one that I don't know much about. So that's why we are here. But anyway, let's start. We would love, if you are watching right now, go into the chat and let us know. Do you own this? Do you own this stock? And if you do, you've done, I think, fabulously well the last couple of months aside, but let us know. Do we have prospective shareholders? Do we have current shareholders watching? And while we wait for those results to come in, my name is Brian Feroldi. I've been investing in the stock market for over 20 years. Here are my personalized returns on the blue line here since 2011, which is when I switched brokers and this chart becomes possible. And the goal of this session here is to teach you how to research a stock from scratch the exact way we would. Now, we're going to be using a tool to do this research called Stock Simplifier. If you're unfamiliar, Stock Simplifier, or if this is your first time joining us, it's a 7-step process we go to figure out what the company does and whether it's worth buying or not. Now, we're going to go fairly quickly through this process, but if you are interested in purchasing Stock Simplifier, it comes with a full course that explains everything that we're doing and why we're doing it. It comes with the spreadsheet tool that we're going to use, like the checklist that we use to research companies. It comes with the AI prompts that we're going to use to analyze this. It comes with cheat sheets, demos, and more. But the first thing to do, Brian, here, the first thing to ask is, which stage of the business growth cycle is this company in? But before we do that, do we have any shareholders here?
Yeah, so I would say we definitely have some shareholders here. I would say we're about 30 to 40% do own it and 60 to 70% don't. And I didn't add, I don't own it as well, although I have started doing some research into it because like you said, there are so many software stocks that are down huge that it's at least worth listening. It's educational, if nothing else.
Brian and I have joked going with each other pretty much every time we do these deep dives. Stillful ends up purchasing the stock,
and I only own 11 stocks
that we just researched. So I said I think you're going to end up buying this one at the end of this research session. But anyway, let's start off with our business growth cycle analysis. A very important first question to ask. There are 6 stages of the business growth cycle. Which of the 6 stages do you think ServiceNow is in? Let us know in the chat. And while we're waiting for those answers to come in, I'm going to go through and I'm going to open up a fresh copy of the spreadsheet tool. I'm going to open up a fresh copy of Fiscal. I'm going to open up a fresh copy of the AI database here. So here is what the checklist looks like when you make a copy of it. It's going to open in Google Sheets. And we're going to go to our dashboard in Fiscal to get that open. And then here's a copy of our prompts. And for this one, we're going to continue to use Gemini as our AI-based research tool. So, all right, Stoffel, what do people think? What's the guess so far about which stage that it's in?
Majority is 4, but we do have a couple 5s sprinkled in there.
Okay, people are guessing stage 4, operating leverage. Okay, so we're going to go to our business analysis, phase analysis prompt. We're going to put this into Gemini. I'm going to paste that prompt in there, and I'm going to zoom in a little bit. If all is going well, it should say.
This will be interesting because our unknown user watching on YouTube knows how our prompts are written and says, I think it's a late 4 or 5 because they have a repurchase program, which is, you have to give it, you've got to give it instructions. And so they think it'll be 5 because of that.
All right. Well, this says, according to Gemini, this is a phase 4 company, operating leverage phase, high confidence. Why? Operating income is a positive figure, almost 3 billion and growing. Revenue is growing 22.5%. That's pretty good. And no capital return program. So Gemini did not find dividends or buybacks in the most recent third quarter filing. So maybe they announced it. I don't know if they've executed, or Gemini could have made a mistake, but I think phase 4 is probably the way to go here.
For what it's worth, I am looking on fiscal.ai. For the last 3 years, they have had a pretty hefty repurchase program.
They have.
Yep.
Okay. So in that case, we'll say capital return. We will say phase 5 if they are indeed buying back stock. So,
but no dividend.
What?
No dividend.
No dividend, but they are buying back stock. So we'll say that they're in phase 5 of the capital return program. Okay, so that's one case when AI didn't find that, which is very interesting. And you know what? While we're here, let's actually pull that up. So we go to ServiceNow.
I went to the cash flow statement and down to their financing activities.
Yep. So financials and then cash flow statement. And you want to go to the financing activities. So repurchase of competent stock, this line right here. So 1.5 billion in buybacks over the last couple of months. And I think if you click this, I don't have access to the ultra premium plan. So yeah, they're buying back about 1 billion in stock. They're issuing about 270 million in new stock options. So that's a net buyback of about $1 billion. Yeah, that to me is a phase 5 capital return company. So, all right, good to see. Good to see we have that done. Next question. What the heck does this company do? Now, to figure that out, we're going to ask questions like, how does the company make money? What are its product services? Who are its customers? And then some qualitative questions like, how frequently do customers buy? Can it raise prices? And what happens in a recession? So I'm going to go to my business analysis prompt. I'm going to run this, and it should be able to help ServiceNow. And this is where it takes quite a bit of time because, again, I don't know what this company does.
So
Brian, something in the cloud, I know.
Yeah, while you do that, I just want to point something out because this is something I have heard. There's 2 things that ServiceNow is really known for. One is that their CEO is always wearing these glasses. It's actually because he has some type of medical condition. But the other thing is, Brian, since this company went public, it has only had one quarter, it was the first quarter of last year, where growth has been under 20%. Every other quarter, growth is over 20%.
Very nice. Okay. And it looks like they're going to be announcing earnings tomorrow.
Yep.
Tomorrow. Okay, then. All right. So what does this company do? ServiceNow provides a cloud-based AI platform, got the buzzword, for business transformation. It acts as a digital connectivity tissue for large organizations, automating and unifying manual work processes across different departments like IT, HR, and customer service. Its Now platform allows companies to manage digital workflows through a single interface, recently integrating generative AI called Now Assist to further automate task resolutions and application development.
Let me just throw one thing in there. I think the fact that it manages digital workflows is really important because I could see how all the rage right now is the fact that we're going away from a seat-based model, right?
Yep.
Like that's why Salesforce, Adobe, all those companies are in trouble. If you manage the workflows, then you can charge by workflow, similar more to kind of like what Snowflake, their model does. So I don't know if they do that, but it offers a pathway forward in a post AI kind of world.
Yep, that is the big concern, I think, and we'll do a sentiment analysis on the company later to double check that. And that's the kind of thing that's important to know. But anyway, how does it make money? ServiceNow generates all of its revenue through software as a service subscription model. 97% of revenue is subscription based, 3% is professional other services. And by product category, 53% is technology workflows. I don't know what ITSM, information technology service management, and the activities performed by an organization. Different, okay? And ITOM. Grammarly's never heard of that. Customer and employee workflows are 24%, and creator workflows like the app engine. So I'm just getting the sense that when you're involved in technology workflows, employee and customer workflows, and creator workflows, you are like behind the scenes business processes, kind of things. You're not going after everyday consumers. You're going after businesses,
and
which is a very hard thing to sell into.
Big businesses.
Big businesses, selling into them is very hard, but typically once you're in there, these tend to be very sticky customers, which is really good. If you're dividing a software as a service business, you want enterprises because they pay more, have bigger budgets, and are stickier customers, as opposed to everyday consumers like us, because we don't have big budgets and we typically cancel at much higher rates. Okay. Who are the customers? Company targets large global enterprises and government agencies. As of Q3, it had 533 customers spending more than $5 million annually.
So this is going after the big fish.
85% of the Fortune 500. Yeah, and you can already tell that they have diversified customer base if they've got 500 plus customers with 5 million in ARR. Okay, where does it operate? Okay, 62% in North America, 26% in Europe, Middle East, and Africa, aka EMEA, and 12% in Asia. Okay, I like this a lot because it shows me North America is the cash cow, but because they're already getting a sizable amount of the revenue overseas, obviously their product translates overseas, and they've already made quite a bit of results with getting their revenue to that level. So this makes me quite excited as a potential shareholder. All right, how often do customers buy? I think we know the answer to this, but revenue is highly predictable and recurring. Customers sign multi-year contracts. The standard is 36 months, so a 3-year contract, and the company has a 98% renewal rate.
That's pretty good.
Software is integrated. It is rarely removed. 98% renewal rate. So that is CrowdStrike level of gross retention. If you will. Can it raise prices? Yes. ServiceNow demonstrates significant pricing power through a land and expand strategy. By bundling new AI features and higher tier modules like Pro and Enterprise, they effectively increase the average price per customer. Subscription gross margin is 80% on a GAAP basis and provides
pretty high
flexibility for the company to capture more as it adds AI capabilities. Finally, what happens in a recession? ServiceNow is considered mission-critical infrastructure rather than discretionary software. While high interest rates or broad recessions can lengthen sales cycles for new customers, 98% renewal rate provides a massive revenue floor. Management notes that during economic uncertainty, enterprise turn to ServiceNow to consolidate other software tools and drive productivity-boosting services. So when things get uncertain, they buy more from ServiceNow. They consolidate.
That makes sense.
On money. Very cool there. And then while we have this open, let's just take a look at that revenue chart that you mentioned before. If we look at total revenue, 29% compound annual growth rate over the last 10 years. If we do say 5 years, 24% compound annual growth rate. And we should be able to do estimates too, right? So. Oh, wow. Significant slowdown. Never mind.
Oh, no, that's just 3 months.
Never mind.
That's just 3 months.
Ignore that. That's full year versus 3/4 of the year. So
Yeah.
it's really this. So what's that? 10.1 to 3. So 20% and then 20%. So Wall Street's still expecting 20% growth there. All right. So what do you guys think now that we know about this business? Red, yellow, green. Is this an attractive company? Red, very unattractive. Yellow, it's good, not great. Or green, this is a very attractive business. What would you rate it now that we know a little bit more about what the company does?
Red, yellow, green. They're coming in. I know I would say green just because highly sticky, important. As you like to say, it's a painkiller. It's not a vitamin.
Yep. This looks enterprise grade software sales are very enticing because the customers have budgets. They are sticky customers and they get into the workflows. I would definitely want to dive even deeper into this, but as a good first pass.
Yeah, this is a first pass. Remember
the high customer renewal rates, the clear sign of double 20% plus revenue growth. I don't know how you would call this anything but green. This to me checks damn near every box you look for in a stock so far from a business perspective. As a side note, if you've never purchased Stock Simplifier before, it's normally $199. If you purchase it using the link that Stoffel's going to share in the chat, you can get it for $99. That is a one-time payment of $99. You get all of the AI prompts we're doing, you get the tool, you get the course. All of that is included, $99. Okay. Moat. Next question. Moat. Does this company have a moat? And we go with a red, yellow, green framework. So there are 5 potential sources of a moat. There's network effects, switching costs, low cost production, intangible assets, and counter positioning. There are 3 potential states of the moat. The current moat could be no moat, narrow moat, or wide moat. And then the moat could be getting shrinking, stable, or widening. So I'd love to poll our audience here. What do you think is this company's primary moat source? If you had to pick one,
for me, this is pretty easy.
What do you think is the benefit of the company's primary moat as of today? Now, while we wait for those questions to come in, let's go over to the moat analysis. We'll put this prompt into a Gemini, and see where it comes up with.
Thus far, everyone's agreeing with what mine would be, which is switching costs.
Okay.
Which is usually
primary.
SaaS is switching costs first, network effects right after that.
There you go. Network effects. You think there's network effects to this?
Well, I mean, with SaaS, like owning that data and things that you can do with it, it's a much weaker one. But I still think with SaaS, it can be there.
I agree with you. To me, this is obviously a switching costs one. It's got work to do to prove to me that there's any network effects at all to this business. Totally, but I look forward to being corrected. Okay, so this says wide and widening, switching costs and intangible assets. ServiceNow projects a wide economic moat rooted in its position as the single system of record for enterprise workflows, with a 98% renewal rate that demonstrates its mission-critical status. The company is currently the only player in its peer group to exceed the rule of 50.
Ooh, someone asked about the rule of 40.
20% revenue growth with accelerated margin expansion. Okay. Wow. Switching costs, wide and widening.
That's the best you can have.
This is its primary strength. Once an enterprise integrates its Now platform across IT, HR, and customer service, the software becomes the central nervous system for business operations. Replacing such a deeply embedded system required massive capital expenditures, employee retraining, and significant risk of operational downtime. So the high renewal rate, very high RPO, which what does that stand for?
Remaining performance obligation.
There you go. Thank you. So great.
Let me take 1 second to address, because Peter brings up, I think, a really important point, which is saying that, okay, so it says switching costs, but software codes can now be generated using AI. Things companies are going to build it in-house moving forward. So one thing that's really interesting to me about what Peter is saying is that I've been listening as much as I can to people. And what I hear by and large is nobody wants to spend the time and the money to do this, to rip out the system that they have and put something new in. That doesn't mean that I don't think Peter's onto something. What I believe is that if, and I don't know the answer to this, but if you can code your way to creating a product that is functionally the same as ServiceNow, it's going to be startups that are just getting started in 2026 that are going to use this. So the big companies of like 2035, that might be true. But I think the operational headaches that you could have from tearing out ServiceNow or Salesforce or what have you are enormous. We're talking, and we know that they only go after huge companies. So I don't think we should downplay that, because that does affect the multiple that you pay for ServiceNow, right? If something's coming 10 years down the road. But I don't think it's going to show up in the numbers right now.
Well, to me, that's what I do whenever I have a question like that. I'm like, okay, this is the narrative. This is the thesis. What do the numbers say? And it might be too early for those numbers to bear fruit. But I think beyond just creating the software, you also have to think about the employee training. You have to think about the switching costs. So let's say an organization is spending $5 million with ServiceNow. That's 5 million reasons to go in-house. That's a sizable amount of money. But do you want to then take on the operational complexity of building all of that, going through the process of transferring it over, making sure that none of the data gets messed up, and then you also have to spend an ongoing fee internally to maintain the system yourself?
Exactly. And you know, for what it's worth, because PJ is also saying it's about the data, not the ability to generate the code. That's why I believe people aren't wrong to say that like Claude's cowork is going to change things. I don't know if this is true, but I think if they are wrong about something, it's the time frame over which that it's the companies being born today where that's going to make the big difference. I don't think it's going to be in the Fortune 500.
Anyway, that's the thesis. That's the narrative. We'll have to watch over the coming quarters to see, is that thesis accurate or is it hogwash?
Right.
Anyway, continuing on, intangible assets. It has wide and stable. The brand carries immense weight in the Global 2000, where it's viewed as the gold standard for IT service management. This reputation allows ServiceNow to command premium pricing and maintain high gross margins. And they're in the multiple Gartner Magic Quadrant leader designations. 85% penetration, huge customer growth, and it's a cut above other enterprise software vendors. Network effect. This does say it has some. Narrow and widening. ServiceNow increasingly benefits from platform network effect via its ServiceNow store and developer ecosystem. As more third-party developers like Deloitte and Accenture build custom apps, the value of the platform increases. Furthermore, its agentic AI partnership with NVIDIA and OpenAI create a data flywheel where platform-wide learning improves automated task resolution for all customers.
Who doesn't have that? Who doesn't have that?
I'll say that you have that advantage over a startup. I don't think that that's like a super wide one. So yeah, I would give them even narrow might be generous, but I'll say it's more than nothing.
When we get to the competitors part, I have one that's coming up in my mind. It'll be interesting to see if you can guess who it is in a bit.
All right, low cost production. They're saying that narrow and stable. Its scale gives it industry-leading margins that competitors struggle to match. Operating margin of 33.5%. All right, and then counter-positioning. ServiceNow counter-positioning against IBM and Oracle, although they've gone SaaS as well. So I won't give it there. Anyway, overall, big picture, red, yellow, green. Red, no moat, or the moat's being disrupted. Yellow, narrow moat, and the moat looks pretty stable. Green, this is a wide moat company, and the moat looks to be getting wider. What do people think is happening with this company's moat?
And while people are giving their votes, we'll see them come in. I'm gonna go with green here. I peeked at some of the numbers too. Again, so I will just point out, Brian, the most important thing out of all the things that we've seen that I think is easy to overlook is that they've only got 533 core customers that are spending over $5 million a year.
Okay.
Those are huge corporations.
Yep.
Huge. Like we're talking thousands to tens of thousands, maybe hundreds of thousands of employees. That's why I would give it a green.
Yep.
Because of that.
I'll also go ahead and say a green. If anything else, you had me at 98% customer retention. Again, forget your thoughts about it. If 98 out of 100 customers choose to stay with you each and every year, that to me is like definitional switching cost. I would consider 95% to be outstanding. I would consider 90% to be great. So 95% is 98% is this company very clearly has a moat. All right, next. Growth. Does this company have long-term growth potential? And what's the story for why this company should be able to grow? Now, in Stock Simplifier, we, of course, teach you, go right over to fiscal, and it has a growth calculator kind of right here. So this is a company that's growing 20% over the last 3, 5, and 10 years. Earnings are growing triple digit over the last 3 years. Revenue is expected to grow about 20%, 19.5%, not 20%, over the next 2 years. Earnings are expected to grow about 30%. And over the long term, earnings are expected to grow about 24% annualized. Now, there's 2 ways to grow. You can get new customers, or you can get existing customers to spend more. So let's go ahead and take our custom built prompt. We'll put this into Gemini. We'll have this run, and we'll see the breakdown of the company's growth potential. So we know that like revenue is expected to grow 20%-ish. How is the company going to do that? What is the story behind why we should believe that that 20% growth is achievable? And this is the kind of business, recurring revenue, high margin business with a 98% customer retention rate, that it makes that growth very, very easy to achieve. All right. So high level, new customer acquisition. This is a major growth avenue for the company. Sales and marketing expenses are $3.8 billion, up from $3.3 billion, as the company is expanding its Now Assist sales force. So this is a major growth category for the company. New distribution channels, strong. ServiceNow launches an enhanced build partner program and simplified its pricing to accelerate partner-led innovation, agentic AI deployment. So new distribution channels. Geographic market expansion, moderate. 60% of revenue comes from North America. The company is targeting new regions with UAE cloud launch and expanded federal GSA agreement. So deeper move into the government and
the Middle East.
In the Middle East. Acquisitions. 2025 was a record year for mergers and acquisitions, with 6 deals announced, including the massive $7.5 billion acquisition of Armis, which is asset intelligence, and the $1 billion acquisition of Veza, identity security. Okay. Existing customer expansion, strong. The company has a Pro Plus and Enterprise Plus add-on modules that include the Gen AI features, which require customers to already be expensive top-tier plans. New products and services, strong. I don't know if I've ever seen it come up with strong for every category, pretty much.
I mean, we're almost there.
And then generate for Now Assist for $500 million in annual contract value, with a target to double that in 2026. And then customer retention at 98%, very high. Okay, so overall, strongest is new product and services with AI, acquisitions, sales and marketing, geographic expansion, and market expansion. So everything except for market expansion, which is only a growth category. Yeah. So I don't even know how many we've done thus far. I've never seen green, green, yellow, green, 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 green. I've never seen that before.
Yep.
With this trend.
Now, it's worth pointing out, AI is not a glass ball. It cannot predict the future. It is not always right. But given that, what do you think? And I just want to throw in, PJ makes a good point. If they plan on transitioning from seats to consumption, which is not something we know for sure, I'm just throwing that out there.
Yep.
They could have significant upside. I agree.
And we'll pick that up in the sentiment analysis at the end, or at least I hope that picks that up. But what do you guys think? Is this a company that has growth potential? Red, no. Growth potential is low or negative. Yellow, it's good. I consider good to be like 10% ish, maybe even mid-teens ish. Green, great. You think this company has 20% plus revenue and or profit growth potential. And since this is a phase 5 capital return, I would emphasize profit growth potential instead of revenue growth potential, although they're both important. So what do people think?
I would say we are greens with a yellow, but mostly greens.
Yeah. This to me is definitionally a company with great long-term potential, with, of course, the caveat being in there that AI could throw a wrecking ball at the company, or at least that appears to be the sentiment on Wall Street right now. All right, up next, key metrics by business phase. The key metrics by phase. I think when I put this together, or actually, as a fresh reminder, if you want to get a copy of Stock Simplifier, everything we're using here, it's $99. Stoffel will put a link in the video chat for everything. Okay, the key metrics by phase. So the key metrics that you look at for a business change depending on which phase of the business growth cycle a company is in. So when a company is in phase 5, we think you should pay attention to revenue, free cash flow conversion, EBIT to interest expense, return on invested capital, and the company's capital return program. Now, we do have an AI prompt that goes out and does this analysis for us. We always double check it though, because this is the one prompt that AI struggles with the most, going out, finding a number, coming back with it. Now, in the course that we have, we teach you how to look up every single one of these numbers in Fiscal, and we'll do that as a backup. But let's just do a quick look using AI, and then we'll see how close the AI gets to the actual numbers by checking them on Fiscal. All right, so the scorecard here. All right, revenue growth was green at 21.9%.
That sounds about right.
Accurate. Yeah. So Fiscal says 22.3. So pretty close there. Okay. Operating margin. This says 33.5 positive and positive and rising. So let's check that out real quickly. Financials. I'm going to close this out.
Hey, Brian, just real quick. Did you use the prompt, you put it in Gemini, and then you gave it the ticker to get these answers, correct?
Yes.
Rodrigo had a question about that.
Yes, correct. Okay. So this says a 13.9% operating margin. I'm guessing that that's GAAP. And let's see if they have the adjusted number here. Adjusted. They have adjusted operating margin. They have adjusted EBITDA margin. That's pretty close. Or EBIT.
Yeah. And
it's EBIT's pretty close.
5.
EBIT is pretty close. So EBIT margin says, call it 30. I mean, what we really care about is the direction. And in both cases, the number, the margin there is up. Oh, actually, is this running this on a phase 4? This is on phase 4. Oh, that's right. We forgot to change it. Okay. Run that again, but assume ServiceNow is phase 5.
There we go.
That's right. We manually overrode it because it got yes.
Good. Hey, Alex, way to go. Look at Alex. He was all over it. He knew.
But the phase 4 metrics look pretty good.
They did. Hey, guess what? The phase 5 ones might look even better. Oh, right. maybe not.
Well, the revenue target for phase 5 is 10%. We do know that that's correct. Okay, next, free cash flow conversion. So this is of your net income. How much of your net income do you convert into free cash flow? Anything over 90% is excellent. Now, this is a software company, so we would expect that this number was pretty darn high.
Yep.
So if we go to ratios, this is the one that I always forget which tab it's in. I think it's margins. I think it's there. It is free cash flow to net income. Look at that. I got it right.
And to remind Brian, we're using fiscal.ai for all of this.
Yeah. So this free cash flow conversion rate is 229%. We want 90 or higher. 90 or higher.
Now, the flip side is that means there's probably some significant stock-based compensation.
Probably. Yes, that's probably the case. Or there's some reason for a delta between the two. Okay, next, EBIT to interest expense. So this is operating income divided by its interest expense. This says it's 20, meaning that the company is debt-free. We want this number to be over 5. So I'll just assume that one is basically correct. Next, return on invested capital. We want this number to be over 20%. This says 12%. Now, that's not all that surprising, given that this company is focused on free cash flow, not NOPAT, as it's called, which is used in the return on invested capital calculation. But let's just see what this says. So this says 9.3. It is rising, though. But let's be accurate and just say less than 10%. So not a good return on invested capital, but the long-term direction is good. And then as we checked before with capital returns, this company is doing yes, but it's only been buying back stock for, I think, 3 years.
Like 3 years.
Yeah. So the only number that is lower than average here is return on invested capital. That's more of a nature of accounting issue than it is the company's actual return on invested capital. But,
and some stock-based compensation.
But overall, pretty good on the key metrics so far. Okay. Next, let's take a look at execution risk. All risk boils down to one risk, and that one risk is execution risk. What are the odds that this company won't be able to achieve the growth that we need it to achieve for investors to do well from the stock price today? So there's a couple of factors that go into that execution risk. There's concentration risk, disruption risk, outside forces risk, and competition risk. Those are the major sub-risks of execution risk. So let's go ahead and put those in and see what Gemini says are the risks in this company.
Now, while I do this, I'm just curious. I don't think they're competitors at all now, but I could see a competitor that goes after big multinational corporations and being their AI digital dashboard.
Sure.
You know what pops in my mind? I'm just curious if you can guess this.
Palantir.
Like, I don't think that one is just right now. It's just ServiceNow is workflows and tasks, and Palantir is data and digital twins. But I see a future where they're going to start encroaching on each other.
Well, let's see. So this says overall, it's a medium, a score of 1.75.
Don't know what that means.
I think that's 1 is low and 3 is high.
Okay.
So the biggest competitors are Microsoft and Salesforce, with AI disruption, seat count pressure, and then high switching costs and platform status. Okay. So concentration, no single customer is 10% of our revenues, and highly diversified customer base. So no concentration risk to be aware of. Okay. Disruption risk, yellow, and this risk is getting worse. While ServiceNow is a leader in agentic AI with its Now Assist platform, it faces an emerging at-risk from AI narrative. Analysts flag concerns that AI-driven efficiency could lead to back-office seat count reductions, threatening its per-seat licensing model. So its customers are going to use AI to get more efficient, leading them to buy less seats from the company, which could lead to lower growth in the future. So AI is both a threat and an opportunity to the company. Next, outside forces, yellow. ServiceNow has significant exposure to U.S. federal spending, and it says that structural risks from government shutdowns and AI hardware tariffs have increased costs for on-premise infrastructure components.
I hadn't thought of that.
I wonder how much of the revenue is federal spending. But again, are they going to pull this out? Is the federal government going to pull this out because of politics? Probably.
Especially if it has the potential to reduce headcount.
Yeah, I would. I'll go with that's not really an issue. I'd go with personally green there, but I understand why it said that. Competition. ServiceNow faces intense competition from Microsoft, AI orchestration, and Salesforce. While its subscription gross margin is elite, the aggressive move into cybersecurity and HR puts it in direct conflict with entrenched companies like Palo Alto Networks and Workday. So it's pushing into cybersecurity. So yeah, competition there is quite high. So no concentration risk. I'd argue no really outside forces risk. Disruption risk for certain. And competition risk looks to be, this says strong. I would say moderate, because it's not like these are new competitors. They've been competing against them the whole time, and they've been doing just fine. So what do you guys think? Red, you think this is a very high risk execution business? Yellow, you think it's a medium risk execution business? Or green, you think the execution risk here is quite low? I'm definitely interested in your opinion, Stoffel, here about how you would rate this company's execution.
All right, so here's what I think. I mean, I agree with Vincent that right now Palantir's not a thing. What I need to know is if they can find let's call it a Goldilocks solution to this seat-based versus consumption-based. So again, seat-based just means ServiceNow gets paid for the 100 employees or the 1,000 employees who have access to its dashboard. Consumption-based is we fired 99 of those 100 because one person can sit in that seat and do the job. If that's the case, they lose 99% of their revenue in theory. If you're consumption-based, then you have to pay based on how much work gets done. And if you do that, you could lower the cost per workflow. But because of, I forget what it's called, Javon's paradox, where something becomes cheaper, instead of demand just stopping, it goes through the roof. I think if they can figure out a way to do consumption, this would definitely be green. But I don't know enough about the industry to know if they can do that.
Well, if you're talking about a business model change or a pricing change, that to me increases execution risk.
Right. Oh, absolutely.
They have to push through it.
So I'm saying
yellow now,
for me, I'm saying if they can figure that out, that's green.
Yeah.
And I have to believe that they can, but again, I don't know enough yet to be able to say that.
Well, I'm going to go with medium here. I don't think this is high risk.
I don't either.
I would say, in fact, I would be leaning towards green myself, because they're already so entrenched. To me, this becomes a yellow or even a red if you see that gross retention rate going down, or if you see a meaningful pullback in the revenue growth rate, which we'll know about tomorrow.
Yeah,
as a friendly reminder. So I'll just put this as a yellow for now. Okay. Put that friendly reminder. If you're watching and you want Stock Simplifier, $99. Stoffel will share a link in the chat. Okay. Finally, valuation assessment. So the valuation metric that we use to analyze a business changes depending on where it is in the business growth cycle. Now, we have identified that this is a phase 5 company. So that means trailing numbers should work okay. Price to earnings and price to free cash flow. With the caveat being that we know from doing the key metrics that there's a wide gap between earnings and free cash flow on this business. Free cash flow is triple what earnings are, and that is due to the nature of GAAP versus non-GAAP accounting. So because of that, I'll definitely follow this, but we should also definitely take a look at the forward numbers as well. This is also a company that's growing. All right. So here we are. And if we we will start with the trailing numbers. So we'll start with trailing price to earnings. Okay. So this says in the multi-hundreds. So this says 82 times trailing earnings. And it got down to as low as
just about, we're right about where it's
all-time low price to earnings ratio. Not all that helpful, that figure there.
No.
Let's take a look at price to free cash flow. This will be much more helpful. Price to free cash flow, 36 times trailing price to free cash flow. And if we put some bands around that, we see that this company usually trades at about 53. And this is a 4-year number. How far back can we go? Okay, 2018 looks like.
And if you're curious, there's really 2 things. I just want to point this out. There's 3 big things that inflates the free cash flow. If you're curious, stock-based compensation is the biggest one. In fact, it's bigger than net income. However, depreciation and amortization, because they're building this on site for these clients,
and they're making acquisitions.
Yes, and the other big one is their unearned revenue, which is that's just people paying their subscriptions right up front.
Yep. Which is a thing that happens on a continual basis.
Yep.
So great cash conversion cycle. So anyway, the call that 7-year number. The average over the last 7 years is about 57 times price to free cash flow. Trailing, this number is currently 36. All right, now let's look at some forward numbers. If we go forward price to earnings, this will be a little bit more instructive. 35 times forward earnings. This we should
something happened.
Get rid of. So that's 2019 when that happened. So, all right. So these are forward numbers. Trading at about, usually trades 58 times forward earnings, or at least that's the average. This was bubblicious time period here, 34 times forward earnings. And then probably most instructive at all will be forward price to free cash flow.
Yeah.
Forward price to free cash flow, 27. Usually trades at 44 times free cash flow. And by usually, I mean, 3 times? But at least that's the average. Mm-hmm. So this is lower than the lows of the crash after 22. How far back can we take this? Oh,
I mean, yeah, it's been a decade since it's been.
This is when it came public.
Yep.
So it looks like their low was 23 times forward free cash flow back essentially after they came public. And then they grew 20% for 10 years plus. And currently trading at 28 times, got down to about 26 times. Okay, so with that in mind, what do you think of this company's valuation? Red, overvalued. Yellow, fairly valued. Green, undervalued. How would you guys rate this? And just from again, filling this out on a price to earnings basis, we know that this was below its average price, although the price to earnings is not that helpful here. Price to free cash flow was definitely below its trailing price, but we include, when we made Stock Simplifier Stoffel, we wanted to limit it to just 2 metrics per one. But with companies like this that are kind of phase 4, kind of phase 5, it does make sense to look at more than one. There's no harm with looking at multiple ones. It's just that the ones that you should focus on.
Hey, I tell you what, if we to take one extra second, one of your favorite things to do is to look at yields. And we don't talk about this in Stock Simplifier, but I wonder what the free cash flow yield is backwards and forwards looking, because I do believe that you can get a forward looking free cash flow yield too, and just compare that to the risk-free rate, which is at what, like 4.2%.
This is Terry Smith's favorite metric to look at for valuation. Yield, the higher the number, the cheaper it is. So you want higher with yield. So from a yield perspective, almost a 3% free cash flow yield. It looks like it got right to 3%. And then it came down to 2.8% free cash flow yield. You think you can do forward as well? Let's take a look.
I think you can. Yeah.
Forward free cash flow yield right there. Forward free cash flow yield is.
So it's still not where the risk-free rate is, but it's not ridiculously low either.
And the risk-free rate isn't growing 20%. So a 3.6% free cash flow yield. So, and that's obviously been consistently higher. So higher is better. So almost a 4% return on a free cash flow basis. But green, yellow, red, Stoffel, what are people saying?
Green by and large. A couple yellows in there. I'd be a yellowish green.
All right.
Looks pretty good.
All right. Now, before we ask you our final question, which is what do you think of this? Let's do that sentiment analysis. So this is an extra prompt that we kind of launched a few weeks ago, and it's just going to give us like the story. So why is this company's valuation trading where it is? So this is going to go out. It's going to analyze the media. It's going to analyze what people are saying online about it. It's going to analyze what analysts think. And
over the past year.
Over the last year. Okay. So overall takeaway, shares declined sharply as investors rotated out of high multiple SaaS stocks and feared that generative AI would shrink the company's seat-based revenue model. The stock hit a multi-year low, but found a temporary floor following a strategic OpenAI partnership announced, looks like a couple of days ago.
Yeah.
The next catalyst is tomorrow. Over the next 12 months, the analysts are neutral, while analysts remain overwhelmingly bullish on the company's fundamentals. The current market's current show me attitude towards AI and valuation multiple compression creates a ceiling for near-term gains. So analysts are bullish on this company. Investors, that's you, yeah, that's us, we're bearish, and the media is kind of mixed there. All right, a transition from peak euphoria about AI in late 2024 to deep skepticism and seat count disruption through 2025. So OpenAI partnership, a 3-year deal announced in January 2026 to integrate ChatGPT and custom voice agents to its platform. Price recently slashed price target to 175. What's the stock at?
It's at 130, 132.
So, okay. So he slashed his price target all the way down to 50 bucks higher. Okay. What the bulls say: untouchable renewal rates, AI is an upsell, and the valuation reset. All right. What the bears say: this is important. The seat count threat. Bears fear that AI automation will reduce the number of human employees needed in HR and IT, eventually killing the traditional per user subscription model. Anxiety acquisition, the large deals as buying growth. So a distraction, and then multiple compression. It's a significant discount to the broader software sector, leading it to vulnerable if its earning growth decelerate below 20%. And its 200-day moving average, if you're a fan of such a thing, is 180. So it's had a bad year. Okay. Overall, we now know, let's summarize what we learned. This is a company that is in phase 5, the capital return phase. It's got a exciting, durable business, a wide and expanding moat, at least for now. It's got still great growth, long-term potential. It did pretty well on its key metrics. The weakest one was return on invested capital, which is mostly due to GAAP versus non-GAAP accounting. It's been buying back stock for about 3 years. The overall AI assessment about risk was a medium risk company, with the seat-based model being the biggest issue. But you are being compensated for that with a below average valuation multiple. So taking everything into account here: red, you're not interested at all, pass, forget this company. Yellow, you want to put this company on your watch list. Perhaps it would be the right buy for you if the valuation kept going down. Or green, you think this is a great buy right now. Right now. What do people think?
I mean, Vince is going to go out and buy it right now.
Okay.
We've got a yellow here. And I get this, Karsten, already heavy into software companies. Need a better margin of safety. Very interested. Yellows, greens, starter position. Bit more yellow than green. I will say I was doing a little bit of research behind the screen. Since you're showing yours, I can go off and do whatever I want. What they've done is they have the seat base. Now, to me, I always love summarizing this by saying, what's the most important nugget from the last hour? To me, the most important nugget, or what I would spend 75% of my time researching, is, can they transition this business model to be more consumption-based? So what they have now is they still have the seat-based model, but they have at the enterprise level, so their top customers, they have consumption-based packs that you buy for your high volume AI-driven workflows. So it's kind of like they've got a tester in there, and they're going to see what works and what doesn't. And then the question then becomes is, can they find, again, that Goldilocks zone of switching from seats to consumption?
Yep. And we've seen other software companies successfully make business model transitions. In fact, every kind of like legacy software company we saw make the transition from on-prem to the cloud. And when they were going through that transition, revenue went backwards.
And investors hated it.
Profits went backwards, and it was often a multi-year transition. But once the transition was made, the businesses became much more resilient, much more predictable. And then the markets really started to reward those stocks. So if this company goes through a similar transition, it's possible that growth will slow, especially as that AI starts to generate more and more revenue for the company. So the numbers, I think they said $500 million in revenue from AI this year, expected to double next year. This is a company doing $10 billion in sales. So that's like 5% of revenue with the hopes to become 10% of revenue next year if it doubles. So it might be a couple of years before it actually is like needle moving growth.
A small base
for the company. So if that 90% of revenue is going slow or worse down with the seat thing, I could see this being this company trading at a low valuation for some time. But yeah, this is going to be a news and story driven company. But to me, if you're bullish on this company, I think there's plenty of reasons to be bullish on this company. I would mark this company as a buy personally.
I mean, Brian, the big thing that the thing that I just have to keep telling myself is, because we go over these opportunities every day, is are we making a mistake in that we are giving more weight to the moat than we should? Because these companies keep coming up: Adobe, Salesforce, ServiceNow. You talked about Constellation Software or Intuit. Are these companies that we're going to look back and say, man, they got disrupted? They got disrupted hard, and they just kept falling and falling and falling and falling. And if that's the case, then we're going to look back and be like, where was our mistake? It was on the moat. It was on the moat. That's where the mistake was. On the flip side, this could be like Meta 4 years ago, where they had one quarter where their monthly active users actually shrank across all their different apps. And people were like, is this the beginning of the end? If it was, it could have kept falling. But we know now that it wasn't. And that was like the best time ever to get in. So it's really tough.
I think Meta at the low was 10 times free cash flow.
Yeah.
So this is the company trading at
30.
If it was Meta again, I don't think it would be. I think this company's revenue is higher quality than Meta's because it's way less sensitive to the economy and overall spending. So I don't think the snapback, if there is a snapback, will be that high. But you're absolutely correct. The numbers that we're going to be seeing this quarter, next quarter, last quarter, they're all trailing. They're all what the company has done. And if the market is sniffing out, the retention rate's going to keep falling, and upsells are going to keep falling to be harder, and seat-based pricing is going to disrupt, and this is going to become a low single-digit revenue growth story while we wait for the AI to kind of pick up. Yeah, this could quote be dead money for a period of years while that happens. So if you already have a ton of exposure to software companies, I would be hesitant to add this one. But if you look at the range of software companies out there, this one to me looks top tier quality from a business quality perspective. So if you're watching this company's earnings tomorrow, which if you're an owner or potential owner, you should, I would personally laser focus in on customer retention. What's customer retention? Is it 98, 97%? If so, you're looking pretty good. And that would be the thing that would tell you. If that starts to dip, if that starts to go down, keep an eye out. Because that if the market sniffs out, oh no, this is the start of the end. I mean, look out below. The sentiment could continue to get worse.
Yep, totally agree.
Cool. All right. Well, thank you guys so much for spending some time with us today. We will be back next week in 1 week. And if you're on our newsletter, longtermmindset.co, if you're not, we're going to be putting out a poll tomorrow in our newsletter tomorrow for what stock you want us to research from scratch next Tuesday at 12 o'clock, same time, same place. Thank you all so much for spending some time with us, and we'll see you next week. Bye, everyone.